All right, quick check before you scroll. If you care about metals, macro, or just not getting blindsided by volatility, you want to hear this. In the last 24 hours, silver didn't just dip. It collapsed. We're talking roughly $120 down to about $97 an ounce. That's a negative 21.5% move in a single day. Over $1 trillion, around 1.4 trillion, effectively vaporized in hours. And here's the part most people are missing. The real trigger isn't what you're hearing on social media. Both futures market data and physical dealer spreads confirmed the same thing almost simultaneously. This wasn't a demand shock. Stay with me, because I'm going to show you what actually just broke, why this matters right now, and how you can recognize this pattern the next time it shows up. Before I explain what caused this, let me teach you something most people don't understand about markets like silver. Price doesn't always move because opinions change. Sometimes price moves because math changes. Think of leverage like stacking chairs on top of each other. It works fine until one leg shifts and then gravity takes over. When a market goes parabolic, it invites leverage. Futures, options, structured products, everybody's confident because price only goes up. But that confidence isn't real demand. It's borrowed exposure. So when price stalls or reverses just enough, the system doesn't ask politely. It forces action. That's the key concept you need in your toolkit. If you're watching this right now, you're ahead of 95% of people who still think this was just normal selling. It wasn't, and I'm going to prove it to you. If this is making sense so far, drop a comment below and let me know where you're watching from. I want to know who's paying attention to this stuff. Now here's what's actually happening. Silver ran hard, very hard. From the low double digits to near $120, the leverage built underneath it exploded. Open interest surged. Margin requirements didn't move fast enough to keep up with volatility. So when price slipped through key levels, margin calls started firing. Let me break down the sequence. First, price dips. That triggers initial stops. Then volatility spikes, which raises margin requirements intraday. Now leverage traders have to post more cash immediately. Some can't. Their positions get liquidated automatically. Those forced sales push price lower, which triggers more stops, which triggers more margin calls. That's the cascade. What you're seeing isn't investors waking up and deciding they hate silver. It's mechanical. Paper contracts unwind faster than physical reality can respond. When you see a 20% move in a day, that's not people calmly changing their minds. That's plumbing. That's the infrastructure of the market breaking down under stress. And the volume told the story. This was liquidation volume, not distribution. You can see it in the speed, in the size, in the pattern. This wasn't retail deciding to take profits. This was forced. Now let me show you the secondary confirmation, because this is where it gets really interesting. Physical premiums, especially in Asia, didn't collapse the way spot did. You've got paper silver getting hammered down to $97. But physical dealers in Singapore and Hong Kong, they're still charging premiums. That spread is telling you something critical. The stress is in the paper market, not the physical market. Real demand didn't evaporate. What evaporated was leveraged positions that couldn't hold on. And that's your first clue that this move was structural, not fundamental. But here's the part that should make you nervous if you don't understand it. These events feel like tops, but historically they often show up near inflection points, not the end of the story. Let me say that again. When you see leverage blow up like this, it doesn't mean the bull case is dead. It often means the leverage phase is dead, and what comes after that can look very different. Now let me prove that with history, because this isn't theory. We've seen this exact playbook before. Go back to 2008. Metals got smashed during forced deleveraging. Gold, silver, everything liquid got sold because margin clerks don't care about your thesis. They care about cash in the account. And what happened after that liquidation exhausted itself? Violent rebound. Not immediately, but once the selling pressure was done, price discovery reset. In 2011, silver crashed from near $50 down to the 20s. That wasn't the death of demand. That was the death of leverage. Parabolic moves attract speculators. Speculators use margin. Margin creates fragility. Same mechanics we're seeing today. And then March 2020. Everything sold off. Stocks, bonds, gold, silver. Why? Because when you get margin calls across your portfolio, you sell what you can, not what you want to. The most liquid assets get hit first. Silver dropped 30% in days. And then what? It doubled over the next year. Every time you see this pattern, forced deleveraging followed by liquidation followed by exhaustion, what comes next is usually a very different kind of market. Extreme volatility spikes tend to mark transitions from leverage-driven price discovery back to real price discovery. That doesn't mean straight up. It means unstable, then clearer. Zoom out and you see the larger story. This is a purge. It's painful, it's violent, but it's not random. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Absolutely. Forced selling doesn't stop just because it feels extreme. Markets can overshoot on the downside just like they overshoot on the upside. Could this be manipulation? Maybe. Could central banks or large institutions be using this as an opportunity to suppress prices? Some people believe that. Here's the thing. It doesn't actually matter whether you believe in manipulation or not when it comes to managing your risk. What matters is understanding structure. Whether it's natural market mechanics or coordinated action, the outcome is the same. You have to deal with the price you see, not the price you think should exist. Focus on what you can control: your position size, your time frame, and your patience. Fundamentals didn't deteriorate by 20% in a day, but positioning absolutely did. That's the distinction you need to understand. There are probably three types of people watching this right now. The first is the person who sold into the panic or got stopped out. If that's you, you're not dumb. The system forced that decision. Your position hit its stop, or your broker liquidated you, or you made the call to cut losses before it got worse. That's rational. Your job now isn't revenge trading. It's waiting. Let volatility compress. Let price prove it can stabilize between roughly $95 and $100 without violent whipsaws. Give it time. Don't rush back in just because you feel like you need to make back what you lost. The market doesn't care about your entry point. The second type is the long-term holder who's staring at their screen, wondering if they missed something catastrophic. Did the fundamental case for silver just collapse overnight? No. If your horizon is measured in years, not days, this was noise driven by leverage, not thesis failure. The reasons you bought silver, whether it's monetary debasement, supply constraints, industrial demand, those things didn't change in 24 hours. What changed is that a bunch of leverage traders got flushed out. That's paper market drama. It's not your drama if you're holding physical or if you're positioned for the long haul. Take a breath, zoom out. This is volatility, not invalidation. The third type is the opportunist itching to buy the dip. I get it. 20% off in a day looks like a gift. And maybe it is. Just remember, timing matters. Patience beats bravery here. Wait for signs of stabilization. Wait for volatility to compress. Wait for the dust to settle. Catching a falling knife feels heroic until it doesn't. Let the market show you that the liquidation is over before you step back in. For everyone, the universal principle is the same. Let the market show you when the fire is out before stepping back inside. That applies whether you're re-entering, holding, or buying for the first time. So here's what I want you to answer in the comments. What's your time frame? Are you trading this, or are you holding for years? Because your answer should determine your response to this. There's no one-size-fits-all here. Your strategy has to match your horizon. So here's where I stand. I'm not panicking, and I'm not rushing in either. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether silver can stabilize and hold in that $95 to $100 zone without violent whipsaws. If we see price bounce around in that range for a few days without breaking lower, that's a sign that forced selling might be exhausting itself. If it breaks below 95 with conviction, that tells me there's more liquidation to come. Second, I'm watching whether volatility starts compressing instead of expanding. When volatility comes down, when the wild swings start to calm, that's when you know the panic is leaving the system. Until that happens, you're still in the danger zone. Third, I'm monitoring physical premiums, especially in Asia. If those premiums stay elevated despite the paper washout, that confirms what I suspect. The breakdown is in the futures market, not the physical market. Real buyers are still there. They're just not using leverage. Based on my analysis, this collapse was structural and mechanical, not emotional or fundamental. The underlying story didn't vanish overnight. Central banks are still printing. Industrial demand for silver is still growing. Supply is still constrained. None of that changed because futures contracts got liquidated. What changed is that the speculative froth got blown off. And honestly, that's probably healthy in the long run, even if it's painful right now. If history rhymes and silver stabilizes after this purge, the move that follows could be significant. Not because of hype, but because leverage won't be in the way anymore. Real buyers can step in without competing with over-leveraged speculators. That creates a cleaner setup. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I'm saying. Look at the data yourself. But if you made it this far, you're thinking critically, and that mentality will serve you well. Most people react. You're analyzing. That puts you ahead. If this breakdown helped you understand what's really happening, share it with someone who needs to see it. Subscribe if you want more of this kind of analysis. And stay sharp out there. Think critically, verify data, and make decisions that fit your time horizon, not the crowd's emotions.